Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Yep.
Okay, before our lecture starts, we're going to have these guys to talk about student management funds. You have 5 minutes, or if you want to go over that, that's fine.
All right. So, hi everyone. My name is Dalton, and this is Harry, and we are from the Student Managed Fund. So, yeah, we're here to talk about this Student Managed Fund. So, it's a undergrad course which can be for 1 semester or for 2 semesters. And the 2-semester intake is preferred, as you'll be a junior in the first semester and then a senior in the second semester. So the fund manages about $650,000 worth of investments, and the objective is to support a scholarship for disadvantaged students. So the fund is a great opportunity to practice what you have learned in previous finance courses, and it also allows you to have a activity-based learning opportunity. So the Student Managed Fund is really beneficial, as it prepares you for a career in finance. So if you're interested in like investment banking or funds management, it will be a great opportunity for you to start. It also allows you to work with really other capable students. And everyone in the fund is really supportive of one another, and you'll be able to learn a lot from one another. And it provides you a really special opportunity to learn from the fund convener and course convener. So they're really experienced in the finance industry, and it'll be a great opportunity to learn from them.
Yeah, so in the fund there's 4 sub-teams, which all work really closely together, but they all have quite different roles. So I'm a part of the Active Australian Equities team, and our role, it's a group of about 7 of us, 4 juniors and then 3 seniors. And basically what we do is very similar to what you may have done or what you will do in corporate valuations. So you'll see that the Corp Val FinM 3005 is a co-rec or a pre-rec for that team. And so what you do is you're basically kind of going through the whole investable universe for the fund, and then analysing stocks as you would in Corp Val, using DCF valuation methods and very qualitative analysis methods to try and find the stocks that are the best pick for the fund, because it's a very long-term investment fund. So once we invest in a stock, we want to hold it for a long period of time. So it's a different kind of analysis method to the quantitative methods, where you're basically just using all the data you can find. So it's a really good way to engage with kind of the industries that the stocks are in, but also the analysis methods that you may use in jobs. And I know people who have gone on from the student managed fund and put those skills on resumes and stuff, like the DCF valuation, and have used that in a professional environment. So it's a really useful team to be a part of if you're looking to be into investment banking or consulting or something like that, or funds management. The asset allocation team, that's the team that Dalton's in, and they pretty much do what you do in this course. So obviously the objectives of the portfolio are very different from the client that we've been given in this course, because the client is the fund itself and the ANU. So the asset allocation team tries to invest the funds that aren't invested in specific stocks into ETFs and other assets to try and diversify and create a portfolio that represents the objectives of the ANU on an ethics basis, but also on a returns basis to meet the distribution and then fund that scholarship for it'll be 4 students every year for 4 years. So yeah, to meet those distribution targets. The risk and compliance team is another sub-team. It's a smaller team, but their job is really important in the fund. And that's because one of the greatest risks in the student-managed fund is not just risk of loss, but also the risk of reputation. So because we're associated, obviously, with the ANU, there's a lot of not only benchmarks, but there's a lot of stuff that we need to account for, such as like our environment and sustainability and governance standards. We need to meet with them. So the risk and compliance team's heavily involved in analysing our portfolio and analysing our potential investments to try and create a portfolio that does comply with the ANU and put us in really good kind of regard for any publicity or any kind of comparison between other universities, student-managed funds, or just managed funds in general. And the relationship team is the other team. So they are basically the face of the fund. And so in the relationship team, you are responsible for social media. So they're running a website. I don't think that exists yet, so don't go looking for it, otherwise you won't be able to find it. But yeah, so they're marketing and also kind of being the fund's ambassador or the person who goes out and talks about the fund in public. So it's a really important role because obviously, yeah, being the face of a fund, especially for a university, is a really important role. The other thing I will say about the four teams is they're not independent of each other. So when you are in the student managed fund, like we work really closely together. So you kind of go out, do your tasks, and kind of do all your analysis independently of each other, and then you come back and work really collaboratively, and you take criticism and take advice from all other people from different teams. So even if you are in a team, say that you've done FinM 1001, which is a prereq for a relationship team, you really want to be a part of the fund, but you also really want to get that sort of technical analysis skills up, then you will actually be able to get that from the relationship team because you're heavily involved in all the processes that happen. Then, yeah, so if you want to apply, the reason we're presenting today is because the applications are open for the fund for next semester. So if you're applying, really think about the reasons why you want to be in the fund and then pick your team accordingly. If you want to contact someone, then the inquiries can go to Jeff Warren, who is the fund convener. If you have any questions, you can submit them to the smf.rsfas at anu.edu.au, and the application form can be found on the RSFAS website as well. And then also, so this is a course as well, so you'll get the same amount of units, so 6 units per semester. So it does count towards your degree, and so you can see the course outline on the programs and courses website. There's sheets here with more information about the fund and also the application process if you want to come down, or if you want to just come down and chat to us, or if we're still here, about that. And yeah, so does anybody have any questions about the fund in general, or more specifically about any teams? Nope. Cool. All right. Well, I really recommend, if you have any sort of like hint of interest in applying for the fund, definitely do it. Don't underestimate yourself, because it's something that is aimed at trying to like build your abilities. It's not just, you don't have to be highly qualified before you enter it. And it's a really, really good team environment to be a part of. And also, yeah, the skills are just like invaluable. Like you don't really get those skills until you're a long way down the kind of your career. So yeah, thanks very much for listening.
Thank you very much. Leave it to me. I'll use this one.
Thank you.
Turn it off, please. Yeah. Okay, finally, is it okay, this volume? Okay. The marking of the mid-semester exam has been finished. From the results of the multiple choice questions, I can tell you did well, much better than I'd expected. The average mark is about close to 70%. So basically, if you have done like 40–50% in the written part, you should be safe to pass. But anyway, because this exam is optional and redeemable, you're supposed to practice for the final exam. So basically, most of the students, over 90%, will do much better in the final. Along the way, hopefully, you're going to spend more time on the course materials, catch up the reading, tutorial exercises, and also, very important, spend some time on the assignment. Hopefully, by the end of this semester, you'll be in much better position to become an analyst. Our final exam is going to be scheduled on the 21st of June, which is almost the last day of the exam period, which is very favorable to the students of this course. So if you have missed any readings, lectures, you can always catch up. And also, because of this, I'm thinking of deferring the due date of the assignment until Friday of week 12, so that you're going to have one more week to work on the assignment. I know that at this early stage, many of you have not started yet, but it's like, hopefully I'm giving you a positive signal. You do have enough time to really think and work well on your assignment, try to get a real good result, and at the same time, learn something useful of long-term value. That's probably my objective, not really your grade. Exam marks can always be scaled. I don't really care that's scaled mark, but I do want you to leave the course with something useful that you can build up in the future for a career or whatsoever. So let's come back to our lecture this week. This week and next week, we're going to talk about alternative assets. They are not actually an asset class. They are a cluster of asset or asset classes which are not traditional equity and fixed income. The reason that we try to spend 2 weeks on alternative assets comes in several reasons. The first reason, in the past 20 years, starting before the global financial crisis, alternative assets became more popular with investors around the world, and they did deliver exceptional performance, and they helped a lot of investors achieve their financial goals, at least up to the global financial crisis. Although during the global financial crisis, because of the nature of the crisis, the credit crunch, and also the illiquidity nature of alternative assets, a lot of investors get burned very hardly during the global financial crisis, and a lot of endowment funds, they had substantial asset allocation in alternative assets. They missed the stock market run-up or recovery because of the illiquidity of alternative assets. When they want to exit the investment, there was no way to get out. So no counterparts in the market to buy these alternative assets. But even though they had this such suffering experience during the global financial crisis, and probably they had to stick with the suboptimal portfolio, they are still a very important source of return. And for some investors, they do provide the diversification benefits for some investment horizons. And another reason of alternative assets is that for some investment within this very broad range of asset or asset classes, some of these assets were used to be providing exotic beta to investors. So the pricing was inefficient, and it could be an area to generate excess return, to beat the market, and some assets within this the very large umbrella of alternative assets, they are still have the chance to provide additional return or excess return alpha. And sometimes you might get exotic beta from these assets as well. So they are important universe. They are important part of the investment universe, and they have the chance or possibility to deliver alpha, beta, and exotic beta. So that's why we spent 2 weeks on alternative assets, and we're going to learn about the possible contribution to total return, risk and return, and their very specific characteristics of understanding their risk and return for investors. The access to alternative assets is very different from traditional equity and fixed income. So when we talk about alternative assets, they are not just one asset class. They might include anything other than listed equity and bond. So here we have a long list of these assets. They are all alternative assets. So that's why we're going to spend 2 weeks. In the first week to have a look at property and infrastructure. The second week, we have a look at other alternative assets. They are potentially very different for investors, and for investors who have very specific risk return requirement, or their very specific investment horizon or objectives. So property, that does not mean residential property or my home. The property market is a very broad range of investments that includes office buildings, retail shops, industrial warehouse, or any facility that you may build and rent out to factories. And infrastructure can be utility, can be toll road, bridges, airports, and these are not uniformly sponsored by government. They can be built and managed by private parties. And property and infrastructure can come in the form of listed or unlisted. For the listed vehicles like listed real estate investment trust or listed infrastructures, the returns behave very much like listed stocks. So they're traded continuously on the stock exchange, and of course the price will incorporate noises and also the timely incorporation of new information. But with the unlisted properties and unlisted infrastructures, there's a huge amount of opacity coming with these investment vehicles. We have no idea of the true underlying value of these investments, and the disclosure is very at minimum level. Hedge funds, again, it's not an asset or asset class. It's a cluster of investment strategies that may involve investment in any assets in any market. Sometimes it involves leverage as well. Private equity, including venture capital. So obviously the private equity companies usually headed by a group of elite managers. They raise funds from investors and make investment in privately owned companies. In some cases, they try to take over the control power of the board and make decisions to fire the existing executives, try to turn around some companies, try to change the strategic policy of the company or everyday management of the companies. In some cases, they try to make investment and stay away from the influencing how the company is managed. It all depends on the founding member or the founding family, how much control they would like to retain before they introduce private equity investment. Commodities. In the past week or so, a few groups asked for gold returns. I have sent you the gold returns, but we're going to talk about the use of commodities next week. So one group mentioned that we want to use gold as inflation hedge. Keep this in mind. It may not be the case as you have expected. We'll talk about this next week. So investment in commodities can be in the form of the actual commodity. For instance, you have like $50,000, you go to buy the gold bars and keep them in a safe. Or if you're very adventurous, you want to buy some crude oil, you can put them in the shed of your backyard. But that's not usually investors will do. They don't hold physical commodities. They go to the exchange or through some investment banks, they buy the collateralized commodity futures or the collateralized commodity future index. So these are financial instruments that to give you the exposure to commodity market. Of course, holding on to the physical commodity is illiquid investment, but buying the collateralized commodity index is liquid investment. Inflation-linked bonds, that's something very interesting. You have done some exercises possibly and some discussion this week. So inflation-linked bond is sort of compared with the traditional bond. They are new assets. For a while, especially in the first probably 20 years, they tend to provide some sort of exotic beta because the demand from investors was quite limited, but there was very strong reason that why investors wanted to have inflation-linked bond in 1980s. Can you remember why? We have been talked about this several times in this course. What happened in 1980s? Yes, high inflation around the world, all of the major economies in 80s until it lasted until early 1990s. So that's when the inflation-linked bonds were introduced into the financial market. Of course, for any new asset into the market, not all investors will instantly become fan of it. So for a while, you could be able to generate exotic beta from investing in the inflation-linked bond. But of course, for most of investors, they still buy and hold the inflation-linked bonds to hedge inflation risk. Now we talk about something probably more relevant, more recent. In the past 10 years of time, we have observed an increasing demand of inflation-linked bond. But at the same time, at least in Australia, in the US and UK, we didn't really observe very high inflation. Why did the investors wanted to hold inflation-linked bonds back 10 years ago? Can you guess? Why did they expect there would be high inflation after 2008? What happened in 2008? Global financial crisis. So we have the event of global financial crisis and triggered credit crunch. And what happened with these central banks around the world? Low interest rate, and at the same time, what's the monetary policy? Quantitative easing. So basically, with the quantitative easing, several rounds of quantitative easing in all of the major economies, the central banks started printing money, giving out, increase the money supply in the economy by huge amount. So with the low interest rate, more money flowing around, really low cost of holding money, what do you expect investor will do? Did someone say spend? And what would investor do when they have a lot of cheap money, low interest rate, low cost of capital? What would they do? If I give you a lot of money, what would you do? Spend it. Yes, we spend it. For investors, we go to buy something that we cannot afford, like new iPad. For companies, what would they do? They hold on to the cash and sit on the pile of cash? Invest. Excellent. So after, with the global financial crisis, several rounds of quantitative easing, the whole world was flooded with cheap money. you will observe optimism in the consumer sector and also aggressive investments from the businesses around the world. At this time, what would you expect to happen with the financial assets? What did you say? Rise in value, and what's your opinion? Yes, so investors will increase their risk appetite. With this strong demand, optimistic investments, optimistic consumption of investors, it's very likely you probably will have asset bubble and what? Inflation, higher inflation. So that's the chain of events involve the market participants, the central banks, consumers, companies. So that's why 10 years ago, in the past 10 years, investors were particularly worried about inflation risk. What's the realized inflation? In Australia, in the US, was it like 5%? Was it a real interest rate, inflation risk? The economy expansion was kind of as expected by the central banks. It didn't trigger substantial, significant risk of inflation, at least in the US, UK, and in Australia as well. The latest inflation, realized inflation in Australia is only 1.3%. We actually have some sort of talking about deflation. So in the past 10 years, there was very high demand of inflation-linked bonds because of the monetary policy and the actions taken by the central banks made some investors believe we're going to have some inflation risk. But actually, it didn't turn out to be substantial risk of inflation. But for some investors, if their primary concern is inflation or preserving the purchasing power of their, especially retirement, the super fund, they do have very strong reason to invest in the inflation-linked bond. UK is still struggling with the negative interest rate, so we are a little bit better. We are very close to zero. US, it's a much better position. What's the recent interest rate decision by Federal Reserve? They just had the meeting this week. What's the decision? No change, okay. And they have expressed very clear rationale of why we want to keep the interest rate right now on hold. And we are observing this list of economic indicators. We may consider moving the interest rate to different directions if this happens, if that happens. To find out the exact monetary policy decision, you have to read this policy announcement from Federal Reserve. There's no recent update from RBA yet. We're going to find out very soon. Other alternative assets, they are anything like forestry, residential property, large settlements, catastrophe insurance, and VIX. And you probably want to bet on the change of VIX. What's the recent VIX? Is it very high or low? Starting from Christmas last year, we have this 4-month up-running stock market rise. The VIX is very low, historical low level, yes. So given the uncertainty of the presidential election and the trade conflicts between US and all of the major trading partners, we have very low VIX, which is a very interesting time for us. We have such conflicting signals from different parts of the market. And lastly, the alternative assets can be collectibles, if you are a big fan of anything. So what are these alternative assets? So different from the traditional assets of equity and fixed income. So one important characteristic of the alternative assets is the illiquidity. Unlisted property, unlisted infrastructure, physical commodity, and also investment in private equity. And in most of the hedge funds, they are all illiquid assets. And there will be a very high transaction cost. And especially for investors who want to exit the position of hedge funds or private equities, there's no way to do that. For instance, if an institutional investor has $300 million in the private equity funds, there's no secondary market at all. In the US, probably that's the most active private equity market. They have very limited secondary market where you can transact the investment in private equities. So when you decide to invest in the private equity funds, you stick with it for 10 years or 20 years. There's no way that you can redeem your investment whenever you want. A lot of assets are actually appraisal-based valuation. For example, unlisted properties. These unlisted property trusts, they are organized in very opaque manner. Usually a specialized property manager will be in charge of the security selection, the property selection, and the management of the whole funds. And they are responsible for reporting the performance and responsible for the valuation as well. So everything is at the discretion of the manager. When this happens, we know, especially when the manager is compensated based on net asset value or the outperformance against the benchmark, they have very good reason to manipulate the valuation or net asset value of the fund. There will be no reliable index or data at all, except the collateralized commodities and listed properties. With almost all the other alternative assets, there's no passive index. It's not like if you want to invest in XXO ordinaries, you can do so at very low cost, and you have confidence what you are investing in. But there's no way that you can invest in a passive index of private equity or hedge funds. There's no such instruments. There are exchange-listed funds of hedge funds or exchange-traded funds of private equities, but they have very limited exposure. It doesn't mean that they're going to have proportionate investment in all of the hedge funds or private equities in the world. They do sampling and they do the manager selection for their investors. And some of the exchange-traded hedge funds, they try to do very good guessing work. They try to mimic the performance or asset allocation of some elite hedge funds. They provide some individual investors the chance to have some similar exposure as these hedge funds. But it doesn't mean that you're going to have an all-inclusive exposure to all of the hedge funds investment in the world. For a lot of alternative assets, the alpha and beta are tightly bundled together. You cannot actually distinguish alpha from beta because we don't have the passive index. There's no way that you can define the beta exposure and then you can disentangle alpha from beta. Economic value add, that's particularly the case for private equity funds and property investment. Some managers are very good at identifying the opportunities to make some changes to the properties, renovation, refurbish, or change the use of the property and introduce new tenants to generate additional value for investors. High fee is probably the most common characteristic with most of the alternative assets, except the collateralized commodity futures or listed property and infrastructures. The high fee is not news anymore, and so they charge as high as 3% of management fee plus performance fee in hedge funds. And with the unlisted property and infrastructure as well, the fee is very high, much higher than the listed investment vehicle. We talk about the listed and unlisted investment vehicles in more details later, especially for the property investment. The challenges in investing in alternative assets is actually manager selection and manager access. For a lot of investments in alternative assets, especially hedge funds and private equity funds, the managers select their investors. And there's no way that you hold like $100 million, you want to invest with any hedge funds or private equity funds. That's not the case. You have to be introduced by the inner circle of existing investors or someone closely connected to that private equity managers or hedge fund managers to be considered as investor in the fund. And also for, as academic, I probably will stand with most of the academic findings. There's no way that you can select an outperforming manager based on historical performance. So what you observe from the hedge fund database or private equity database, the published performance, you're not to select the outperforming managers for the future. There's no way you can do this. So the performance, the outcome from investment in hedge funds and private equity is very discrete, or sometimes you probably don't want to use a general rule to make the investment decision. Other challenges of investing in alternative assets are the opacity. That's probably the very common problem with most of the alternative assets. For hedge funds, private equity funds, unlisted property and infrastructures, there's no regulation that requires them to report in a certain way on a periodical manner as the listed companies. So they might issue this statement of the net asset value or the financial report of the fund for their investors every year or whenever they feel appropriate. Or sometimes you will find this reported performance, even though some hedge funds are to some extent more transparent than some other funds, the reported performance is subject to a lot of bias. The manipulation of the managers, the survivorship bias, and also other bias factors. So the historical performance of these investments are going to be misleading if you're going to rely on the historical performance to make investment decision. For example, survivorship bias. There's no regulation that in any country that hedge funds or private equity funds are required to report their performance. So all of the reporting is voluntary. And reporting to a large hedge fund or private equity fund database is a marketing event. So it's often the case that after several quarters or months of stellar performance, the funds decide to report to a database. So this is a voluntary process, and there will be no regulation to oversee how they calculate the performance. They probably will have their own auditor, but it's not regulated. So they're going to report the performance to a database and use this as marketing material, and because of the stellar performance in the past several quarters. And when the fund is in trouble, they will stop performing, and the performance, any reported historical performance, will be left in the database. So it doesn't mean that when the fund is closed, the trace of the fund is going to be removed completely from the database. Whatever you observe in the database are survived hedge funds or private equity funds. If you're interested, you might do a Google search. I'm sure you will find some statistics. The closing rate of hedge funds or private equity funds in the US is astonishingly high. I'll leave this exercise to you. You might find out how often they close. So that's managers generate the huge amount of the management fee. They charge a base rate, that's the management fee. On top of that, they charge a performance fee. But they can charge millions of dollars of management fee without performing or making any alpha for their investors. Because of the opacity, there are other problems that for investors, we do not know the exact holding of these hedge funds. So there's no way that you can manage your portfolio on the total portfolio level. So for investors, only the total portfolio level risk and return are meaningful, and also the tax consideration as well. So when you have no idea your exact holding in these hedge funds and in some unlisted investment vehicles, there's no way you have 100% control or understanding of the risk exposure. Whatever you have liquidity need or when you have such cash flow need, there's no way that you can have this in your consideration when you invest in some alternative assets. The governance issue with alternative assets has always been headline for a lot of media coverage, especially after a financial crisis. The Asian financial crisis, the global financial crisis, every time we had such financial crisis, hedge funds are usually blamed for the excess market volatility. And that's exactly the case after the global financial crisis. So starting from 2008, in the European Union, they have increased the regulation of hedge funds and private equity funds, but it's still not at the same level as the listed investment vehicles. The governance has always been an issue, and particularly for the unlisted investment vehicles like infrastructure and property, there will be the equity issues for investors who come to the fund first and for the later investors. It comes in this way that the valuation of unlisted properties and infrastructure is subject to the valuation cycle. So they are not going to value the property portfolio, for instance, every day, every week, or every month. This can be done quarterly or even annually. So when they have a new investor and the manager has the discretion to decide how the current value of the property portfolio is going to be. So they may use the last valuation cycle of net asset value, or they come up with their own estimate of net asset value. So the new investors' number of units are going to be calculated based on this estimated net asset value. And they decide, okay, this is the number of units entitled, and you, on the book, you're going to record it as holding 1 million units of our fund on this date. But what if the value, the net asset value of the fund is undervalued or overvalued? So when in the future the value is corrected, the new investors might suffer the loss because they did not receive the entitled number of units at all. So that can create such equity problem with the unlisted investments like property and infrastructure. The type of property investment, So we have this spectrum starting from the left-hand corner of core investments. So with these core investments, they are typically less volatile. They have stable rental income, these kind of very good tenants, for instance, large corporations like Coles, Woolworths, these retailers. When we move to the right, we have the listed real estate investment trusts. So these real estate investment trusts in Australia, in different countries, they can be quite exposed to different segments of the property market. In Australia, the real estate investment trusts are usually exposed to residential property market, retail, and office. So these are the main segments of real estate investment trust. In the US, it's much more diversified. So when we move from core property to the listed, you increase the expected return because you move from core properties to some other segments of the retail property market. For instance, in Canberra Centre, just opposite Coles, you will find a lot of other shops of the takeaway shops. If you're going to classify Coles and the takeaway shops or bakeries into this spectrum we have here, you actually have Coles and Woolworths. Even Aldi, they are this kind of very good tenants. They are part of the core property market. So usually, this kind of property will come with lower risk and, of course, lower expected return compared with the non-core properties. So with the bakeries, takeaway shops, restaurants opposite Coles, these properties are non-core properties. So there might be a higher risk. The cash flow of these tenants, of course, they may offer higher expected return. When you have the same size of two properties, you have one tenant of Coles, the other tenant as a large restaurant. So obviously, Coles is going to have much stronger bargaining power to negotiate the rent and to sign a lease of 50 years, for instance. Although the rental can be linked to CPI, but you probably have to give some discount to secure this high-quality tenant. When you negotiate with the restaurant owner, you probably have to consider the higher risk associated with the cash flow of the restaurant. For instance, just in that north quarter of Canberra Centre, what's that Italian restaurant? Jamie's Italian closed its door a while ago. So that's a very good example of higher risk and non-core property. So you have this higher risk tenants, and you probably want to negotiate a higher rent with these tenants. With the opportunistic investment properties, and these are at much higher risk. Of course, the expected return is much higher. For example, if 10 years ago, before the building of the second Sydney airport, you had foreseen that Sydney is going to experience this exponential growth of population, and the existing airport is not enough, and you have several candidates of the second airport sites, and you have this correct bet of the site of the second airport, and you go to stock up a large parcel of land that's very close to the airport site, and you probably will just make a very handsome amount of profit selling the land to the property developers, or you developed the property by yourself. So this kind of investment in property comes with higher risk and, of course, higher expected return. So on the second page, you will have this more detailed explanation of different categories of property investment. There's no way that we mean the property market when you do a Google search like this. If you do a Google search like property market slump in the media, you will have this property market slump, property price downturn. They all refer to the residential property market, especially in Sydney and Melbourne. For investors who hold a very diversified portfolio, residential property is only a very small, a tiny part of the investment universe. So don't get yourself confused when you read about property in this course. We mean the very broad range of investment opportunities. So how can an investor have access to exposure of other segments of the property market other than the residential? They can go to buy the real estate investment trust. From the library, you have access to e-resources and databases. And under D, you will have this data analysis premium. In there, you have access to all of the financial data, market announcements of all listed companies in Australia. So here I have, I'm not sure if it's still open. Okay, it's still working. So I use this search tool over here, the search tool, and give you a list of all of the listed real estate investment trusts in Australia. So now there are only 46 of them. This is tiny compared with the US market or the global stock of real estate investment trusts. So along the list, you will find some companies that are very small, and this one, I'm not sure if I can use this. No, it doesn't work here. So that $3 million of market cap, that's probably the smallest real estate investment trust. The largest real estate investment trust in Australia used to be Westfield Group. After several years of restructuring, and it has shifted its focus from Australia to the US market to cater to the needs and requirements of US investors. Westfield has been in the process of restructuring to divest the Australian assets from the Westfield Group. So right now, what we have here, the legacy of Westfield Group, is one of the most successful Australian firms in history. We have this Scentre Group. That used to be the Westfield Australian Retail Trust. So that's a very specialized real estate investment trust in retail properties. That's the second largest real estate investment trust in Australia now. The largest one is Goodman Group, this one. So if you're interested, have a look at this real estate investment trust at your own time. We'll have a look at this in the second hour after the break. I'll get this page displayed again. Next, we're going to have 5 minutes break. If you have any questions, come to talk to me. If we look at the segment report performance of Goodman Group, you will find, okay, they are not only involved in Australian market, they have exposure to the property market around the world. So when you invest in Goodman Group, one of the real estate, that's the largest real estate investment trust in Australia, you actually have the indirect exposure to the property market in other countries as well. So that's how you're going to understand your exposure. And also, if you look at the industry of the company, that's the segment reporting. They have development, that's property development, and also property management income as well. For other companies, another still real estate company, but they are not real estate investment trusts. So the major business activity of these companies are managing and operating properties. They don't usually develop a property or sell the properties. So you will see the GICS industry classification in the right-hand corner as real estate management and development, but it's not a real estate investment trust. And if you look at the business summary, they have development, construction, and investment management business. It's quite different from the real estate investment trust. Of course, there are some sort of overlapping, but when you invest in the real estate investment trust, they usually generate the income from property development, property investment, and funds management as well. The funds management doesn't mean that they raise money from investors, invest in whatever assets they like. It's not like the funds management of Colonial First State or AMP. So the funds management means they invest in property market. In a lot of cases, on behalf of a third party, for instance, a large institutional investor, they have these billions of dollars as allocation into property. They will hire these specialized property managers to do the security selection and manage their property portfolio. For investors, it's very rare that individual investors would like to invest in a property development project or infrastructure project because of the sheer size of the investment. So for extremely wealthy investors, it can be the case of joining a syndicate. And for some institutional investors, if it's allowed by the mandate, you may join the syndicate to invest in property development project or infrastructure project. Structuring the property portfolio, that's probably more relevant for investors who hold a diversified portfolio. When we make an investment decision like asset allocation, now we have very clear case. We're going to allocate some funds into property market. How much and in what segments of the property market? That decision depends on the investor's objectives and risk constraints. For example, the client in your assignment, they currently have over 60% exposure in residential property market. Of course, it's very concentrated risk. If you're going to advise to diversify this concentrated risk in residential property, how are you going to advise them to diversify this risk into real estate investment trust, the listed properties, or other unlisted property trust may diversify into other segments of the property market, for instance, industrial, office, retail, whatsoever, or you want to advise your client to shift the funds from residential property into other asset classes. That's in this way, the overall portfolio will be more likely to satisfy the objective and constraints of the clients. So hopefully after this lecture, you will have a better understanding of constructing or asset allocation of property. Now, as always, the asset allocation decision will start from the objective. With the core and non-core property investment, obvious, with the core investment, you're going to have lower expected return, lower risk. But with the non-core investment in property, you expect higher return. Of course, you have to bear higher risk. So the decision is going to be dependent on the investor's objective. Is it just for a certain level of return but lower risk? Or if the higher risk level of non-core property is acceptable for the investor? So it depends on the risk preference of the investor if they want to introduce the exposure to property market. With the listed and unlisted, things are much more complicated, and because they are so different, and the implication for investors can be quite complicated too. Here we're going to discuss a few differences of the listed and unlisted properties, and at the same time we have some discussion of what sort of investors would prefer listed and what kind of investors would prefer unlisted properties. For instance, the pricing method. Obviously, the listed property trust, they are priced sort of efficiently, timely, continuously in the stock exchange. And with the unlisted property trust, there will be substantial lag of any shock to be incorporated into its net asset value. So with investors who are worried about the lag, or for investors who would like to have this timely manner of valuation, who have the liquidity need of the property exposure, they probably will prefer the listed form of property exposure instead of the unlisted property. And the supply-demand imbalance. Most investors, individual investors, have ready, easy, low-cost access to listed real estate investment trust. So they're traded, accessible like any other listed companies. There's much lower cost accessing the listed properties. But with the unlisted properties, unless you're a high net worth investor and you're introduced to the specialized property managers, you may join that unlisted property trust. Or for some institutional investors, if they have this kind of very clear definition of what kind of exposure they would like in their total portfolio, they might go to the unlisted property trust. Most of the unlisted property trusts, they have their own expertise. So if one manager is specialized in retail, they only invest in retail. Some other managers are experts in industrial or office, they only invest in that kind of property market segments. But with the unlisted, with the listed real estate investment trust, you actually have exposure to different segments of the property market, because some of the real estate investment trusts are specialized in retail, like Center Group, or some real estate investment trusts are specialized in funds management or operation of the properties. So it depends on your need, your specific need of exposure. Asset composition in Australia, that's the case that the most of the listed real estate investment trusts have concentrated exposure in retail. With the unlisted, depending on the manager, they can have exposure to one segment, or they might hold a diversified portfolio. Exposure to other business risk. With the unlisted investment property trust, they only invest in properties. So they don't have exposure of other business. But with the unlisted property trust, some of them are involved in construction, operation of the properties, management of the properties. So the cash flow, the revenue is more diversified, and at the same time, you probably will have exposure to additional business risk. Gearing is one very striking difference between the unlisted and listed property trust. Before the global financial crisis, most of the Australian real estate investment trusts were at a leverage level of between 60 to even 80%, which was very high and is very high up to today's standard. So that's why a few of the largest real estate investment trusts were in big trouble during the global financial crisis, which triggered credit crunch. If you can do a Google search of Scentre property, so they were very close to the bankruptcy border, and also they were involved in class action from shareholders as well, because they didn't disclose the short-term debt in a timely manner to their shareholders. So shareholders believed they received the misleading information from management, and that caused the substantial loss of the shares. Currently, the typical leverage of real estate investment trusts listed is between 30 to 50%. That's usually the industry average you will observe for listed property trust. For the unlisted property trust, things can go to quite extreme. With the core property managers, they only invest in core properties, and they have these good quality tenants. There's very low level of risk involved, and they use very small amount of leverage as well. Partially because of their own risk profile, partially because you don't really have very much growth in that segment. So they don't need this large amount of leverage at all. But for some other managers in the unlisted property trust, they're specialized in the non-core properties, or they try to generate value add for their investors. They try to beat benchmark, generate alpha. Sometimes they will take on additional leverage to try to boost the alpha they are hoping to generate. So, of course, for investors, depending on your risk tolerance, your preference of the gearing, how much leverage would you like to include in your total portfolio, you may decide to go ahead with the listed or unlisted property trust. For individual investors, access to the listed real estate investment trust is much easier. Next, I think I'll just choose a few topics like cost. Investing in listed real estate investment trust is at very low cost compared with the unlisted, but there's a sort of trade-off for investors. When you go with the low-cost investment, you have exposure to business exposure like funds management, property development, or even construction, probably which you are not desired at your total portfolio level. If you are okay with the higher fees charged by the unlisted property trust, you might have the chance to generate enough alpha to compensate for the higher fees. Because with the unlisted property trust, the managers might be very good at identifying the undervalued properties or change the use, revamp the property to generate additional economic value for their shareholders. Still, the judging these performance of the managers based on historical return is very difficult and very tricky job. So we'll go back to our summary. With the listed choice between listed and unlisted property trust, if your primary concern is liquidity, you probably want to go to the listed real estate investment trust. If you are very much worried about the opacity or governance problem with the unlisted, you probably want to invest your funds into the listed real estate investment trust because they are regulated as any other listed companies in Australia. They have to report and disclose in certain ways, and so that to make this fair access of information for all investors. If illiquidity is not an issue, and also if access is not an issue, and you have the capacity to absorb or to accept the higher risk associated with some of the unlisted property trust, you may go ahead with that investment decision because you might have the chance to generate additional source of returns, no matter from the beta exposure to the property market or the value add created by the property managers. And also for a lot of investors, especially institutional investors, they do make investment with the unlisted property trust. And that proves to be a good diversifier of a multi-asset portfolio dominated by equity and fixed income. Unlisted and unlisted property trusts complements or substitutes. It really depends on your investment horizon and also depends on the investor's objectives. We have done the exercise of how unlisted property will lag behind the listed property to absorb the external shocks, and also the resulting underestimated correlation with equity and underestimated standard deviation of unlisted properties have been shown numerically. So if your investment horizon is short-term, like, for example, you're a manager of a diversified portfolio and your performance is compared with a benchmark portfolio and your performance is measured every month or every quarter, obviously, you probably will have this investment horizon or review period of short term. You might want to have some exposure to the unlisted property market because of the underestimated correlation and underestimated standard deviation. They might provide the benefits of diversification in short run and might be able to reduce your total portfolio risk to some extent. But if you have very long-term investment horizon, for instance, 10 years, 20 years, for a lot of individual investors, we probably want to hold a diversified portfolio, but considering if the unlisted property is a good addition to my existing portfolio, you have to make some careful calculation. Because over long run, no matter the property trust is listed or unlisted, the performance is going to be driven fundamentally by the economic performance of the country. Over long run, the correlation of unlisted property will catch up with the correlation of listed property with the equity. Although it's not completely the same, but they're going to get very close in long run. Not just standard deviation, correlation as well. Because the fundamental driver is the economic health of the country. So they are supplements or substitutes or complements. It depends on the investor's investment horizon and their objective. It should be analyzed case by case. Just like the equity market, Australian property is a tiny bit of the entire investment universe in the world. So Australian equity is about 2% of the world equity. Australian property, of course, is still a tiny part of the world equity property market. So if you are okay for exposure in the property market in other countries, you probably want to invest in the foreign property market. There might be more chance of generating economic value add, generating exotic data for some part of some property market in the world, the pricing can be inefficient. It might be the chance to generate excess return. So I'll give you a list of summaries. Depending on your need for your total portfolio, you might have the asset allocation in both listed property and unlisted property, or invest in either one of them. Inflation hedging is something that you're going to do some exercise on this in your tutorial. With the inflation hedging, at least from the available historical performance, we understand that for the listed real estate investment trust, they are not good inflation hedging. And probably because with the price of the listed real estate investment trust, they are exposed to different business segments like funds management, construction industry, and the imbalanced demand and supply in certain segments of the property market. But with the unlisted property trust, especially over medium to long run, they are a good inflation hedge. It's possibly through the channel of rental income, because for the unlisted real estate investment trust, most of them generate their income solely from the property market, from rental. So it's very common that rental income is linked to inflation in some way. So it can be that when they negotiate the lease contract, it can be stated in the contract that this is this year's rental and there will be a 2.5% increase every year for the next 30 years. Or it might be linked to the realized inflation, like it's going to be 3% above the average inflation or end of year inflation for every year. Or every few years, you might negotiate this the lease agreement. So with the rental income closely linked into inflation, unlisted property trust is a much better hedge against inflation, especially over long run. The investment in infrastructure, it has always been classified actually as defensive assets. In Australia, we have the infrastructure company listed like Transurban. It owns and operates a few of the major toll roads in Sydney, and also including the fantastic failure of Lion Cove Tunnel. So they are often labeled as monopoly. So some of the infrastructure companies, they have this kind of monopolistic power. There's just this toll road is over there, like Cross City Tunnel in Sydney. That's the only Cross City Tunnel. You use it or not. You might go up onto the ground and get stuck. So they do have this certain monopolistic power in some circumstances, and also the toll is linked to inflation. They have been increasing the toll, crossing the Harbour Bridge, using the Cross City Tunnel in Sydney, because I've been driving there for 10 years. I know the increase of the toll crossing the Harbour Bridge. So for these reasons, a lot of people believe investment in infrastructure is sort of low risk and at very similar level of equities. So they believe introducing infrastructure into your total portfolio can be a good diversifier of the equity risk, but it provides a higher return, marginally higher return. So that will improve your risk-return trade-off of your total portfolio. That's not the case, actually. That's the misunderstanding of infrastructure investment. Not all infrastructure investment have the quasi-government guarantee or the monopoly in certain areas. For example, if you believe Sydney Airport is the only outlet you can use, and they have this market power of to negotiate with all of the airways and the freight companies like DHL, now here comes the second airport. Of course, in Canberra, we still have that one airport. There's no other choices. So this monopoly can change. So the risk of their cash flow might increase in the future. And also, there can be some substantial upfront cash flow risk as well. This graph shows the toll road stock total return index. If they are truly defensive stock, like the retailers, for instance, Coles or Woolies, the volatility you observe here should not be like a characteristic of a true defensive stock. Especially during the global financial crisis, a defensive stock will protect investors in this market sell-off. So obviously, Transurban, Macquarie Infrastructure, they are not the low-risk defensive stock. And with these infrastructure companies, I give you the annual report of Transurban for that year, and you will see this large share value drops because of the construction problem of the toll road in Melbourne. That's the case. The circled stock price changes because of construction problem, the conflicts, the problem with some of their subcontractors. There are real risk of the cash flow or the success of the project. So infrastructure stocks, infrastructure projects are not risk-free, and they might come with substantial risk. And that's the case we observe with Transurban. If you like, have a look at the red line here. That's Macquarie Infrastructure. The problem with Macquarie Infrastructure is something different in a way that they came into the market at the right time. That's the early 1990s, when the communication, transportation, utility, and energy industries in Australia became privatized and deregulated. And that's where the Macquarie Infrastructure came into the market. And they had a very good run, very good performance in the following years, and the managers took home millions of dollars of bonus and performance fees. But they were in a trouble of operational problems within the fund itself, and also they were involved in several not so successful infrastructure projects, and that's why you see that's the downgrade of the value, the relative return of Macquarie Infrastructure. It's at high, it was 2 times better than the ASX 200, and later it was acquired by Canada Pension. It's not in the market anymore. So investment in infrastructure does come with substantial risk, and the risk might come from the uncertainty in cash flow, uncertainty of the infrastructure project itself. It might come from the quasi-guarantee or protection from government as well with the infrastructure projects. Just now, a student approached me to talk about the recent government budget. There's a highlight in the recent government budget of making billions of dollars investment in infrastructure. For Australian investors, now we have this government investment in billions of dollars in infrastructure over the next 10 years. How can you get a bit of that. How can you benefit from there? Of course, if you live in congested cities like Sydney or Melbourne, you're going to benefit from reduced travel time. But financially, how can we benefit from there? Just simply go to buy any infrastructure stocks in the market? Is that easy? No, probably not. The infrastructure investment may benefit different segments of the economy in an even way. Simply going into the stock market, buying the infrastructure stock, that's not the case. That's not the way that you make investment decisions. First of all, you need to find out how much of this money is spent on the infrastructure projects, which state will get the most pie, the largest pie of that infrastructure investment, and in what segments. Road, toll road, or any other infrastructure construction, and who are going to build these infrastructure projects. For indirect exposure, you might go by the building materials and invest in construction companies or the companies that are going to provide services to these infrastructure projects. But simply buying infrastructure stock is not the way to go. So with the infrastructure, like property, we have the listed and unlisted access. With the listed infrastructure, there's much more regulation and disclosure. You understand the projects they are investing in, and you probably will have better understanding of the risk involved. With the unlisted infrastructure, on the other hand, you probably will have limited information of the risk and expected return, because the valuation is going to be subject to the modeling of the managers. So next, I'm going to show you an example of Lion Cove Tunnel. That's another example of how the infrastructure project might fail your expected return you get from infrastructure investment. So this is a private investment, not listed at all. So this is the map of Sydney, and you will see on the lower right-hand corner, we have the city centre. For residents living in the upper North Shore or northwestern part of Sydney, they have a few ways to travel to Sydney, North Sydney and Chatswood. These are the major CBD business area in Sydney. So that's probably will be the most likely traffic. So from the northwestern area to the city, and you have a few options. And along the line, sorry, I'll use the computer here. It's much easier. So the traffic will be very much more likely from the northwestern of Sydney to this part. And from there, you're going to have a train line here through Hornsby, Pymble, and Chatswood to the city. And another way is from here, M2. And another way is from this road over here. That's the Victoria Road, notoriously Victoria Road. So for people, that's a very populated area, blue ribbon suburbs. And so they came with the idea of building a tunnel over here, connecting M2 to the major business area of Chatswood, North Sydney, and further to Sydney. See, that's the Lane Cove Tunnel. That's grey area. So they had the modelling of estimating about 100,000 usage per day when they have this Lane Cove Tunnel. And they forecasted that there will be substantial use by traveller commuters from the northwestern part of Sydney to the lower North Shore or Sydney CBD district. They've spent a little bit over $1 billion on the building for the Lane Cove Tunnel. And the outcome of the usage of the tunnel was out of everyone's expectation. It was not even half of the expected usage. I'm very curious how they did the modeling and forecasting, because obviously you forecast the usage of the tunnel, you got to have like the income level, a lot of demographic parameters like the income, the commuting distance, and people's willingness to pay the toll to use the tunnel. But I tried to find the model, but didn't get anything. Anyway, the model proves to be totally wrong. The actual usage after the Lane Cove Tunnel was completed was only half of the estimated usage. So I was there in 2010 and 11. I used to drive through Lane Cove Tunnel every day in the morning. Even at 9 o'clock, there was no traffic in there. It was so quiet, and you wouldn't believe that you're under Lane Cove. That's on the ground. It's very busy, narrow road. So what's the reason? Basically, from the northwestern part of Sydney, it's a Blue Ribbon area. There was no problem with people's income to pay for that a few dollars. But the problem is that you have to pay for it twice every day. And that's going to amount to the increasing cost of housing, utility, and all the other living costs in Sydney. And at the same time, the road on the ground from the northwestern to the lower North Shore was not that congested. And you still can avoid some of the traffic by leaving home earlier, using the Victoria Road, Pacific Highway, or you can catch the train. And also from the Hills District, that's part of the very populated area. They have express bus. So 45 minutes, limited stop, you are in the city. So that's probably some of the reasons caused the failure of the Lane Cove Tunnel. It went to administration in 2010 or 11, around that time, and sold to Transurban for a little bit over $600 million, about 40% loss over 3 years of time. So unlisted infrastructure investment obviously comes with substantial risk. So obviously it's not investment for individual investors. For institutional investors that have invested in this project, they have to suffer that 40% of loss over 4 years of time. Right now, the traffic has picked up a lot because of the increasingly congested road in Sydney. But the use of Lane Cove Tunnel is still not as expected. That's 100,000 use every day. Hopefully, this is going to change some of your misunderstanding of investment in infrastructure. They by no means defensive investment at all. The extreme leverage in infrastructure can be a problem for some investors, especially when the government is involved. the leverage can be up to 90%, especially for the public-private partnership projects. So for the construction, both the private and public, the government will contribute. And for 20 years, the private company is going to operate and get the profit. And then after 20, 30 years, they're going to retain the ownership of the infrastructure project to the government. Even in this case, sometimes leverage can be a problem. For investors who have clear definition from the mandate, for instance, the leverage exposure, the kind of risk exposure as a result of the high leverage, you got to be very careful of this infrastructure investment. So the contribution of infrastructure in the total portfolio context is very similar to the property market in the way as they both have listed and unlisted, and they can be the additional source of return, and at the same time, you might have substantial illiquidity risk. And there may be substantial hurdle of investment as well. Like UniSuper, they do have large funds under management, and they do hold a large portfolio of property or have investment in infrastructure, but the mandate actually stops them from directly investing in an infrastructure project. So there's no way they can join a syndicate to build an airport, build a toll road. Their investment has to be through like specialized managers or through some hedge funds investment vehicles. Okay, so to wrap up this lecture, I would like you to change your misunderstanding of the property investment and infrastructure investment in the sense that you have to assess the contribution to the portfolio at the total portfolio level, no matter the return or risk. And also the introduction of property, no matter it's listed or unlisted, an infrastructure into the total portfolio, it has to be linked to the investor's objectives and constraints as well. The constraints can be liquidity need, or there may be leverage risk preference from the aspect of the leverage exposure of the listed or unlisted or infrastructure projects, or the kind of exposure you like to introduce into your total portfolio. It's not like as simple as investing in a residential property. It is by no means investing in property means holding a portfolio of investment of residential investment properties. There are quite some readings on WATO. So especially with the supplementary readings, the aim is to help you to build the knowledge in this asset class. So no specific details from the supplementary readings are going to be examined in the final exam. Only the concepts we cover in the lecture, or any concepts you're going to discuss in the tutorial. So like, I'll give you, this is the final exam question. I'll give you the question, and you have a few months to think about it. I'll give you an investor case, something similar as the mismatch exam, the portfolio, the existing portfolio, the investment horizon, the objective, and I want you to give an advice to invest in the direct property or listed or unlisted property, and give me the reason. So you might use the assignment as a good practice. Think about the case of the client in the assignment. And if you finally, after running the model, and you decide there should be like 15% exposure as allocation to property segment, property asset class, how are you going to advise your client to invest in unlisted or listed property?